Hi, folks. Welcome to the Ask Weekend Investing Round 59. In these series, we take a look at all queries that we receive, whether they're related to the markets or products or momentum investing or anything else which we can discuss on public forum. We will certainly try to answer them. Disclaimer as always, please read fully, understand it. There is no recommendation, there is no intent to give any advice here. Do like and share these videos and subscribe to the channel if you like the content. 880 queries have been answered across previous 58 rounds. All those 58 round links are available in the description. And let's start with the first one. Manjunath says, please share what conditions you use to find momentum stocks, at least briefly. So, majorly, our conditions are basis price and volume. And we also filter basis any red flags that the exchange or SEBI may have put up for the stock. Related query is that if someone is from non-systematic orientation, what should he be wary of in terms of adapting to momentum style? So when you are coming from a non-systematic orientation, typically you are finding that following a momentum strategy will give you some uneasy time because in your previous role you were in full control over your decisions, and in a non-systematic non sorry in a non-discretionary strategy like momentum investing, you would basically have to follow what the system is telling you to do. So sometimes there will be conflicts, whether where you may think that the stock the system is buying is overbought or perhaps does not have room for it to go, and you may sometimes also be right. But the fact is that if you are following a strategy, then you have to accept that perhaps 50% of its trades will go right, 50% of the trades will go wrong. But the key part is that over a longer period of time, most of the 50% of the gainers that you will have will make you a lot more money than the small losses that you will have on the other side. So the math needs to be understood because it is a math based solution. I mean, you are using price, volume, etc. for your filtration, but eventually it comes down to the math behind it. That even if there are half winners, half losers, I want to win big in the winners, and I want to lose less in the losers. Which in non-systematic orientation is almost always opposite. That people take small profits and large losses, and this is completely reverse of that. So the mental makeup gradually can happen when you will see success in your non-discretionary mode. Then you will basically understand that how easy and how relaxing this style of investing is once will have confidence, and that may take time. So till then you will have some uneasiness because it's like driving a car and sitting next to a driver. It is almost like that, where when you're driving your car, you feel totally in control, although you may also bang the car. But when you're sitting with the driver, I mean, you will take time to uh, uh, have confidence on him or her. So that's sort of the mental makeup. It's all about mental makeup, actually. There's nothing more to it, really. uh, Manjunath has another question. Thank you for the snippets every day. I'm invested about 60% in weekend investing and wanted to do another 30% in Nasdaq 100 fund. What's your view for long term? Is this a good idea? So I'll tell you in general because I will not be able to give you any personal advice that is against my license. Uh, so in general, I would say that if this is your uh, entire sort of portfolio, then I would like to see some asset allocation also here. But if asset allocation is beyond this and this is only the equity part, then a good diversification to US stocks is good. Uh, how much it should be the ideal diversification for you to US stocks is something that your financial advisor or planner will be able to tell you. Uh, Weekend Investing also has a US product which it offers on the vested platform, but that is beyond our uh, basically our SEBI license. That is a separate activity, and and if you like, you can use that as well. Harish says, how do you plan SWP, systematic withdrawal plan strategy for retirement using momentum strategy as small case does not have an option? So small case has a option of partial withdrawal where let's say you have 10 lakh rupees in the system and you will want to withdraw 40,000 rupees. So you can tell small case that I want to withdraw 40,000 and it will be proportionately from all your holdings, not disturbing the weights that will remain. It will withdraw 40,000. So that much is possible. Now, how systematically whether that withdrawal needs to be 4%, 3%, how it has to increase or decrease, that is of course your business, that small case can't do for you. But small case certainly has a partial withdrawal ability where incrementally from each stock basis how much they are allocated, it will withdraw the money. Sai Kiran has a question. Thanks for all the knowledge sharing each day. You're welcome. Absolute. My question is on absolute momentum strategy. If we take any underlying index, strategy would be picking the max of let's say 20 stocks. Then within which each stock will either enter the trade or sit in cash until it finds a momentum. Since we first pick best of the index and then momentum comparing to its own momentum, isn't this combination of rotational and absolute? So, not in the real sense, because a rotational strategy would take care of, let's say, Nifty index, and you are, let's say, running an absolute momentum strategy on the Nifty index. So, to that extent, your universe is fixed. That these are the 50 stocks that I'm taking a look at. But beyond that point, it is the performance of the 20 stocks that is going to get them into the portfolio, and there is no rotation happening there. So if none of the stocks are performing, strategy sits in cash. If you find 20 stocks are doing very well versus the other 30, you are basically allocated to them. So rotational is not really there in the strictest sense of the word. Nagesh says, what is the advantage of having fixed gold versus variable gold in strategies like evergreen and all? So there are some advantages and of course there are some disadvantages. The advantage is that you are very comfortable with 25% or 20% or whatever may be the allocation there, with that much allocation. And there can be times when if I were to keep it variable and stocks are not performing and gold is performing, and that usually is the case whenever stocks are not performing, the strategy may tell you to buy 80% gold, 90% gold. Even if you cap it at 75%, it can be a large number. A lot of folks are not comfortable with that idea, although it will work wonderfully well. And I can give you a sneak peek that you will see something coming out of on those lines soon as a product. But that will exclusively be for those people who don't mind going to a higher percentage on gold when it is required. Now, that of course cannot be your, you know, sort of irregular portfolio where people already are, very scared when you have more than 10% gold. Even in these two strategies, the ones you're mentioning, we have 25% and I think 20%. Uh, this is more to do with how to, not have a situation where we go extreme gold. Although I know it will make money, but it is all also a comfort of holding. I mean, if users are not comfortable holding, then they will drop out of those positions, and it will basically be no good. The additional impact of variable gold be negligible from a performance point of view. So this I've already mentioned, that you can have fantastic performance if you let it go variable. And fixed gold is certainly very helpful if there is a black swan or a sudden event. Uh, so let's say some collapse happens tomorrow and gold goes 2x in the next 1 week, you'll certainly get the benefits of that. Puneet says, I'm a subscriber of NNF10. Momentum investing, as you have explained, is getting out of losers and staying with the winners. That is correct. For example, Nifty Junior is not performing. Then how do you justify a rotational strategy and not moving to cash? As a more recent subscriber, I've noticed capital erosion happening in the rotational approach. Okay. So the fundamental idea behind such products is that We are trying to beat the index. NNF10 is trying to beat the Nifty Junior Index, and that's the intent of that product. Now, assume you are holding the index. Let's say you are a subscriber of the index, not NNF10, and Nifty is going down. What will you do? Will you stay with the Nifty because you have chosen to be with an index and you're saying, come what may, let it go up and down, but I know that the index is going to perform over a period of time? So, similarly, it is designed on the same traits of an index, that consider NNF and 10 to be an index, and it's a perhaps a superior index where instead of 50 stocks bogging you down, you are trying to get to the best 10 at all times. So you are at all times trying to outdo the underlying index. So the intent is not to go to cash for that reason. So there will be periods where it will get painful. I mean, index was down 70% in 2008. So it doesn't mean that index funds will get out of index and sit in cash. So the intent and the design of the strategy is to behave like an index and try to improve on it. Avinash says, if you begin investing in a systematic strategy only when it agrees with your gut feeling, are you truly following the system or are you just being selectively obedient? Okay, I'll have to read it again. If you begin investing in a systematic strategy only when it agrees with your gut feeling. So there is no if and but in following a systematic strategy. Either you are following or you're not following. If you're not following, then there's no point being there. And if you're truly following the system, I mean, you have to go to the last mile and follow it. Uh, so from that point of view, you have to learn to give up control and trust the system, so that you can override your emotions and eliminate second guessing, which you have rightly said. So mindset will not come overnight, but it will come, with discipline and sort of walking that path. It is exactly same as, when we want to reduce 10 kgs of our body weight. What do? We will go and, start running, go to the gym, do whatever. But then if we go twice and then don't go after that, the entire purpose is lost. And if we keep continue at it, these small steps then start to snowball into something bigger. It is exactly that once you will let go, it's basically, that DDLJ scene, Ja Simran Ja. You have to do that you are giving up control. You're saying, okay, go live your life, my portfolio, and you'll do all right. So the trust has to come. The trust will come with time. uh, Back tests or historical performance will give you some of that trust. uh, the manager perhaps can also give you some confidence if you have been following him or her for a long period of time. So you have to see, I mean, how to build trust and how to follow that it may and make it habitual. So that you are not questioning the, as I gave you the example in previous question also. If you are sitting with your car driver and you're questioning every move that he makes, that why did you turn this, why did you put this gear, why did you brake, then you will have a horrible journey. To find a trusted uh, pilot or a driver and just follow along. So Nitesh says, how can we make the decision of booking profits in weekend investing strategy? Should we wait for certain indicators or nifty levels or something else? So the idea here is that there is no concept of profit booking as such within the strategies, and they are designed to keep compounding over periods of time. Of course, they will lose money when markets are coming down, and they will gain money when the markets are going up. So, depending upon what your financial advisor, financial planner will tell you, that 2028 you need so much money. So from 2026 onwards, you should start to reduce some equity and move into perhaps more some uh, maybe some debt-based product or something that will sort of prevent any wealth erosion, because that is your 2028 is your kids' education expense. So it is those milestones that you have to plan for. Now, strategies also will not be at all-time highs at whenever you want. So whenever you feel that market is has done really well or you have done really well, you can take something off the table. That's no issue at all. But if you're trying to time the system that, I'll get out whenever market is against me and I'll get in whenever market is in favor, that is a very difficult thing to do. Some people can do it. You can plot your NAV and plot a moving average, and whenever it goes below, let's say 100-day moving average, 50-day moving average, you can get out, and whenever it comes back in, you can get in. That's also possible, but I'm not suggesting you to do that. uh, Goal based planning should be done, and whenever you need money, plan to take some money gradually out of the system, uh, much ahead of that goal. Srihari says, what is your view on historical returns of real estate versus equity markets globally? Am I right in my assumption that I will buy with partial loan a residential property in my later years with the returns earned from equity? I don't know what you will do. I mean, uh, I would suggest, uh, why wait for later years? If you can with partial loan, you should buy a residential property now. Uh, what if there are no returns from equity? Then you will have no equity and no house also. So this influencers have really, ruined this entire generation by telling them that you don't need to buy a house. I am sorry that I am of a different school of thought. I would think that uh, housing be as important as real estate, at least, as equity, uh, if not more. So my sense is that whenever you can, put half of your money towards EMI, half of your money towards equity market. Why you want to do 0 100? That either way I will go here or I will go there. uh, Work hard and make sure that you are able to sustain both. And it's not that you have to buy the biggest house right now, which you have to stretch out. Buy something small, and every 5 years, when you find that you are able to do more, you can flip that into a new one. So my sense is that a house gives you a lot of security, even though you may have bought it at loan. Number one. Number two, uh, it gives you phenomenal insurance benefit. What if something happens to you? Your family at least has a roof on their head, and the loan will get paid by your life insurance. So no worries on that. Uh, Three, of course, is loans are available at 8%, and you will hopefully make 12 to 15% in the markets. So, even if you have the money for the house, take a loan. Home loans are very good loans. They can leverage you well, and if you are able to get some timing right in the real estate market, you can make a lot of money. So, my view has been that, and the fourth benefit, of course, is that a house, the chunkiness of the house, because of the uh, friction in buying and selling and additional costs, etc. A house you will buy for a long period. Stocks, maybe you will keep for a few years. You may flip one day. There may be some news in your stock and you will flip it the next day. So the ease of flipping the stock is actually the reason why a lot of people don't make money in the stocks. If there was a gun to your head, and you say that, okay, you have to buy stocks but you can't sell before 5 years or 10 years, you'll probably make money even if you choose a very strange bunch of stocks. So this chunkiness of the house, and the fact that it's a big ticket, where you have put in some money and loan has put in some money, you are making money on top of that, on the entire thing, and you are keeping it for a long term forcefully. And the EMI is a gun to your head that you have to pay every month. SIPs you may stop. I mean, I know so many people right now who have stopped SIPs because they are saying we are not getting returns in last 6 months, blah, blah, 1 year we are stopping SIPs. But EMI you will not stop. So that is a very nice gun to your head, actually, in my view. Um, and having a short term view on stocks is very easy. I'm not making returns in the last 1 year. Let me give up on my portfolio. So you have to take a very pragmatic view of the situation. This two assurances that you have, that I will live forever and I can always buy a house whenever I make money from equity. These are myths in your mind that one should get out of. You may not last till tomorrow, and by you I'm saying anybody, could be me also. uh, so you can't plan for that, that I'll do well in equity for next 10 years and then I'll buy a house. It may not happen. You may not be there. Second, of course, is What if there are no returns in equity? I mean, Chinese folks have sat around for 10 years, last 10 years with no returns. Hong Kong folks, Japanese folks, are we, is there some special uh, blessings on us that we have to keep growing every year? I mean, things can go bad anywhere. Perhaps Sri Lanka, Nepal, and Bangladesh were also thinking they will keep growing. Look at where they are. Look at Pakistan. So I can go on on this, but try to be more rational and more realistic, I would say. Unnamed subscriber of MI20 says, if the overall market trend is downward, what is the point of repeatedly buying and selling at a loss? Wouldn't it make more sense to focus on booking small gains instead of taking small losses? This is impacting MI20 performance. So, yes, in the downtrend, you will see a lot of trades that are, you know, repeatedly buying or selling at loss. But you have to understand the entire picture. The entire picture is not last 6 months or 1 year. The entire picture is a 5 to 7 year period. Over a 5 to 7 year period, has MI20 done well? You have to check that. How does changing the strategy in this period impact when the markets will be bullish? Who will tell us that the market is not doing a loss right now and it's going to gain tomorrow? When that flip happens, uh, you will book a small gain and the stock will go multifold up. Then how will you make money in this strategy? So my request is that don't question the strategy. The strategy is a proven strategy and it has proven its worth. uh, these current times are a part of the game. If you will feel that you will make money every week, every month, every year, then stock market is not the game for you, because stock markets will be two steps forward, one step back always, for everybody, not just this strategy or any investor. uh, Even Warren Buffett, Charlie Munger, they all know how the stock market behaves, and you have to accept that behavior. That's the end of Fast Weekend Investing Round. Thank you so much for your queries. I hope I was able to do justice with the answers that I gave you. You can always use this hashtag in the comment section and put in your queries, and we'll take it up next week if you have missed your question this week. All previous episodes are here in the description in case you wish to go through them. Do a binge watch of them this weekend if you like, and you'll come out to be a better investor, I am hoping. Thank you so much for watching. And I would have one last request, that please do subscribe to our channel and do like and share these videos. Thanks. Bye.